So guys, this video we're going to talk a little bit about seller financing and wealth generation. Hopefully you'll find the video helpful. If you do, take a minute and like the video. Take time and subscribe to our YouTube channel as well, and make any comments below. We'll do our best to get to those comments and answer them for you. So through the 35 years I've been in the real estate investment industry of all types, I've had the privilege of doing pretty much everything in the books that you can do, from the fix and flip mechanisms to selling through retail, selling with owner financing, selling notes, leasing properties, owning hundreds of rental properties at one time. Done a few wholesale transactions that were lucrative at least. We've done short-term rentals, we've done long-term rentals. And so we played this whole gambit of the real estate investment game. And so oftentimes when I get a chance to put on a seminar and I'm comparing and contrasting, for instance, a rental scenario versus a seller finance scenario, I get a chance to do this and show why I believe the seller finance option is the same profitability as the rental option over, say, a course of 30 years. It's just that it's a path of least resistance that's out there. Of course, the pushback I get on this is that at the end of 30 years, you own this rental property, let's say debt-free. Got it. Maybe it's gone up in value a little bit. But let's talk about that for a minute. And I'm going to go back to the real estate crash of 2008, 2009, where if you had a house that was worth $100,000, it dropped maybe 50% in value to $50,000. What I found interesting is as the market slowly rebounded, going back to 2014, 15, 16, they'd say things like, well, the values of homes have come up 25%. Eventually, through 2018, they've gone up 50% in value, or they've regained 100% of value. Well, it might have taken 10, 11 years to get back to where it was from the time that it went down from 100 to 50. Because if a house is worth $50,000 today and it goes up 50% in value, it's only worth $75,000, not $100,000. So you still lost in that scenario 25% of your equity. On the flip side, if you held a owner finance note and the value of that property dropped to 50, the value of your mortgage did not change. It was still worth $100,000. Also, think about this. The income that you can get on a $50,000 house now is going to be much less than the income you're getting on your $100,000 mortgage. And so over the years, as that rental property is slowly catching up in value to your owner finance mortgage, you're collecting a lot more money on positive cash flow than you are on that rental property. So all that combined, you can see where you can get a lot more additional money out of that owner finance transaction. And it's a much more safe type investment in my scenario. Now, if you look at the path of a rental property over the years, the average tenant stays in the property about 2 years. If the roof needs replacing, the landlord's putting a new one on. When the AC goes out, the landlord's putting a new one in. If the commode is running, the landlord is fixing it. If there's any other damage or issues to the property, it's the landlord's responsibility to fix it. On the flip side, if you have a owner finance transaction and those things occur, it's the owner's responsibility, not yours. Also, when a house goes vacant under a rental scenario, it takes some time to release the home. Oftentimes, you might be paying a rental commission to somebody and things of that nature along the way, whereas with a owner-occupied owner finance sale, they pay any loan servicing fees, you pay nothing. You've got property management fees on the rental side, and I can go on and give you all these pros and cons on both sides of the equations. Now, if you look at this over the scope of, say, a 30-year timeline, where at the end of 30 years, I've got my owner finance property that maybe I sold it for 110 cents of value. Maybe I'm collecting 110% of the rental value. I have no downtime, no repairs, etc. But I look at the rental property where I have downtime every 2 years, repairs, maintenance, that at the end of these two time frames, the dollar amount of the extra cash I made over 30 years versus the extra money that I now have because I own my house debt-free, I think my owner finance property wins. Also, you've got to think about this. To do either the rental property or the owner finance property, you've got to have capital because you must put long-term financing in place. Well, to do that, there is a down payment required for whether the rental property or the owner finance property. The difference is with the rental property, you don't get any additional money to replenish that money you paid out of pocket. With the seller finance property though, I get a down payment back from my buyer. It's that down payment I get that allows me to buy two, or actually allows me to buy three owner finance properties for every two rental properties I can buy using the same amount of money. So again, if I'm using this 3-to-2 ratio, I'm using the apples to apples scenario over the course of, let's say, 30 years. I strongly believe that the owner finance mechanism greatly outweighs the tenant scenario. And not only that, but there is a path of least resistance because it's much easier to collect a mortgage payment than it is to manage a rental property and go through all the fees, issues, tenants, toilets, and trash, as we call it, along the way. Yeah, you get to do what's called depreciation with a rental property. You don't get to depreciate anything if you did a seller finance on the property. However, if you depreciate a home, you get the privilege of recapturing that whenever you sell a property, meaning you're going to pay those taxes at some point in time along the way, either now or later. And I get all the games they play with that, but the bottom line is you're paying it. If your income is going to go way down in the future, great, you pay a smaller tax rate. But if you're someone like myself, my income levels, thank goodness, are never going to go down. At least I sure hope they don't. Meaning my tax rate's always going to be the same. For me, it's the same thing, only different. Maybe a minor deferral type scenario. That's it. So I can stop and give you guys some examples where we have bought a property from a seller who actually owned the property debt-free. We bought it with seller financing. We were able, over the course of 2 years, to totally pay off using short-term Airbnb tactics on this one property. And all of the capital we paid out of our pocket, all the capital was paid to buy the furniture and whatnot to do it, within that 2-year period was totally paid off to where we were now collecting positive cash flow along the way. And we were able to now create equity from the seller financing, knowing how to play the rental game on the backside. On another property that we did seller financing with, we were able to create equity almost out of thin air on a property that had $200,000 of debt and renovations owed against it that was only worth about $210,000. We were able to buy this home, sell it with seller financing, get our down payment, and able to create out of nothing $65,000 of equity, as well as $1,000 a month of cash flow. Wound up being a home run. So I can look at both scenarios. It doesn't mean that being a landlord is wrong versus being a seller financing person is wrong, or that either one is right. However, historically for ourselves and our companies, we have found that the owner finance mechanism, using seller financing to buy and sell with, truly is the best mechanism for going out and generating wealth. It is the path of least resistance that allows us to do more transactions this way versus less, and gets us on the path to that long-term recurring cash flow that everybody is seeking. So guys, if you found the video helpful, take a minute and like the video. Don't forget to take a moment and subscribe to our YouTube channel. Don't forget to comment below. We'll do our best to get to those comments for you. And we'll look forward to seeing you all next time.